Have you ever wondered what cryptocurrencies are and why Bitcoin is so popular? Well, let's dive right into it. Cryptocurrencies, in the simplest terms, are digital or virtual forms of currency designed to work as a medium of exchange. They're like your dollars or euros, but without a physical form, and they're built on cryptographic technology that ensures secure transactions. Now, you might have heard of Bitcoin, the first and most well-known cryptocurrency, or Ethereum, a close second, with its smart contract feature. These digital currencies are more than just a new way to make purchases. They're also seen as a speculative investment with values that can skyrocket overnight. And Bitcoin? Well, it's a fascinating story of resilience and growth, and we'll be discussing it in detail. So fasten your seatbelts as we delve deep into the realm of cryptography, decentralization, and digital finance. Stay with us to explore the world of cryptocurrencies and Bitcoin's enduring popularity. So what exactly is a cryptocurrency? Well, let's break it down. The term cryptocurrency is a combination of two words, crypto, short for cryptography, and currency, which is a medium of exchange. Cryptocurrencies, then, are digital currencies that use cryptographic techniques for secure transactions. Imagine a world where you can make payments or investments without relying on central banks or governments. That's the world of cryptocurrencies. They are decentralized and operate on technology called blockchain, a distributed ledger enforced by a network of computers, often referred to as nodes. Now let's talk about the stars of the show, Bitcoin and Ethereum. Bitcoin, the first ever cryptocurrency, has been a trailblazer in this digital revolution. Created in 2009 by an anonymous entity known as Satoshi Nakamoto, Bitcoin introduced us to the concept of digital money that could be sent and received without any intermediaries. Then we have Ethereum. While Bitcoin was primarily a digital currency, Ethereum took things further. Launched in 2015, Ethereum is not just a cryptocurrency, but also a platform for developers to build and operate decentralized applications, or dApps. It introduced a feature called smart contracts, self-executing contracts with the terms directly written into the code. These two are just the tip of the iceberg. There are thousands of other cryptocurrencies out there, each with their unique features and uses. Some aim to improve transaction speed, some focus on privacy, while others aim to revolutionize industries like finance, real estate, and even entertainment. But remember, the world of cryptocurrencies is not without its risks. While they offer a new and exciting way to conduct transactions and investments, their volatile nature and lack of regulation can also lead to significant losses. Now that we understand what cryptocurrencies are, let's dive into the rise and popularity of Bitcoin. Bitcoin has seen a meteoric rise since its inception, but why? Let's take a step back to the year 2009, when the world was first introduced to Bitcoin. The brainchild of an anonymous individual or group known as Satoshi Nakamoto, Bitcoin began as a relatively obscure digital asset. It was valued at just a few cents, and was primarily a topic of interest for tech enthusiasts and cypherpunks. Fast forward to today, and Bitcoin has become a household name, with its price reaching unprecedented heights. This growth didn't happen overnight, though. It was driven by a combination of factors including increased public awareness, acceptance by major businesses, and the rise of blockchain technology. One of the key factors influencing Bitcoin's price is its built-in scarcity. Unlike traditional currencies, which can be printed at will by central banks, Bitcoin has a cap of 21 million coins. This limit creates a supply and demand dynamic that has played a significant role in Bitcoin's price fluctuations. Another critical aspect of Bitcoin's journey is the phenomenon known as halving. Approximately every 4 years, the reward for mining new blocks is halved, effectively reducing the rate at which new Bitcoins are created. This event, known as the halving, has historically led to significant price increases due to the decreased supply of new coins. However, it's not all smooth sailing. Bitcoin's journey has been marked by periods of extreme volatility, with prices soaring and plummeting in short time frames. Despite this, Bitcoin has shown remarkable resilience, bouncing back from numerous crashes and continuing to attract new investors. This resilience can be attributed to Bitcoin's decentralized nature, which makes it resistant to censorship and interference from governments and financial institutions. Additionally, Bitcoin's transparency, security, and potential for high returns have made it an attractive asset for many investors. So, what's the takeaway here? Bitcoin's rise is a testament to the power of innovation, the potential of blockchain technology, and the growing appetite for alternative forms of currency and investment. Despite the challenges and uncertainties, Bitcoin has carved out a significant place in the financial landscape and continues to influence the way we think about money. With a better understanding of Bitcoin's journey, let's explore how cryptocurrencies work. Cryptocurrencies aren't just about buying and selling, there's a whole technology behind them. Imagine a ledger, a book where you record all your transactions. Now, imagine this ledger is duplicated across a network of computers and updated in real time. That, in essence, is the blockchain technology, the backbone of cryptocurrencies. It's a decentralized system where all transactions are transparent and tamper-proof. Every transaction made is packaged into a block, which is then added to this chain of previous transactions. This system ensures the integrity and security of the information, making it nearly impossible to alter or counterfeit. But how do these blocks get added to the blockchain? Here's where mining comes into play. Miners use powerful computers to solve complex mathematical puzzles. The first one to solve the puzzle gets to add the block to the blockchain, and in return, they receive a reward, typically in the form of the cryptocurrency they're mining. However, this process is energy intensive and has sparked debates about its environmental impact. Now let's talk about the different types of cryptocurrencies out there. We often hear about Bitcoin and Ethereum, but did you know there are over 5,000 different cryptocurrencies? They're generally classified into two categories: coins and tokens. Tokens, on the other hand, depend on another blockchain to secure their transactions. Tokens are often created and distributed through an initial coin offering, or ICO, somewhat similar to an initial public offering in the stock market. Each cryptocurrency serves a unique purpose. For instance, Bitcoin was designed to be a digital currency. Ethereum, on the other hand, was designed to facilitate programmatic contracts and applications via its own currency, Ether. Then there are tokens like Binance Coin, which users can use to pay fees on the Binance cryptocurrency exchange. Now that we have a grasp on how cryptocurrencies work, why do people invest in them? People often see cryptocurrencies as an investment opportunity, but why is that? Cryptocurrencies, the digital currency of the future, have captivated the minds of investors worldwide. They offer an allure that traditional investment options often don't: a chance to be part of a technological revolution, a new monetary system that is decentralized, borderless, and seemingly limitless in potential. One of the main reasons people invest in cryptocurrencies is their speculative nature. Speculation in this context means betting on the price of these digital assets to increase over time. We've seen stories of Bitcoin millionaires, people who bought the currency when it was worth pennies, and who are now living the high life. It's these stories that fuel the dreams of many crypto investors. But let's not forget, cryptocurrencies are highly volatile. Their prices can swing wildly from one day to the next. This volatility can lead to significant gains, but also substantial losses. It's not uncommon to see the value of a cryptocurrency drop by 20, 30, or even 50% in a single day. This makes investing in cryptocurrencies a risky proposition. The risks associated with crypto investments extend beyond price volatility. There's also the risk of theft. Despite the sophisticated cryptographic security measures in place, hackers have managed to steal billions of dollars worth of cryptocurrencies over the years. Furthermore, the lack of regulation and oversight in many parts of the world means that investors often have little to no protection if things go wrong. It's a wild west out there in the world of cryptocurrencies, filled with both opportunity and danger. So while the potential rewards of investing in cryptocurrencies can be high, so too are the risks. It's important for investors to understand these risks and to only invest money they can afford to lose. Cryptocurrencies should be part of a diversified investment portfolio, not the whole thing. Remember, every investment decision should be based on careful research and consideration, not just the lure of quick riches. Investments come with legal and regulatory considerations. Let's explore this next. The law and cryptocurrencies have a complex relationship. Let's unravel it. When we step into the world of cryptocurrencies, the first question that often comes to mind is this even legal? The answer is not as straightforward as one might hope. Cryptocurrencies, being a relatively new phenomenon, have sparked a lot of debate among lawmakers and regulators worldwide. In many places, cryptocurrencies find themselves in a legal grey area. They aren't recognized as legal tender, which means you can't use them to pay your taxes or settle debts. But at the same time, they're not illegal, meaning you can buy, sell, and own them. However, the lack of a clear legal status doesn't mean that cryptocurrencies are lawless. Far from it. In fact, they're subject to a wide range of laws and regulations, from anti-money laundering rules to securities laws. This can make navigating the crypto world a bit of a legal minefield, especially for newcomers. Taxation is another thorny issue. In many jurisdictions, cryptocurrencies are considered property for tax purposes. This means that if you sell your crypto for more than you paid for it, you could be liable for capital gains tax. But the rules can vary widely from one place to another, so it's always a good idea to seek professional advice. Now let's take a quick trip around the globe. Some countries like Japan and Switzerland have embraced cryptocurrencies with open arms, implementing regulations that promote innovation while protecting consumers. Others, like China and India, have taken a more cautious approach, imposing restrictions or outright bans. These differing attitudes reflect the broader uncertainty surrounding cryptocurrencies. They're exciting and full of promise, but they also pose new challenges for regulators, who must strike a delicate balance between fostering innovation, protecting consumers, and preventing illicit activities. As the crypto world continues to evolve, so too will the legal landscape. It's a dynamic, fast-paced field, and staying informed is key. After all, knowledge is power, especially in the world of cryptocurrencies. With a grasp on the legal landscape, let's weigh the pros and cons of cryptocurrencies. Like any technology, cryptocurrencies have their upsides and downsides. First, let's delve into the advantages. Cryptocurrencies, being decentralized, offer a level of autonomy that traditional banking systems can't. They grant you full control over your money, free from the prying eyes of governments and banks. This makes them an attractive choice for those who value privacy. Moreover, cryptocurrencies bring about a sense of inclusivity. They provide an opportunity for people who might not have access to traditional banking systems to participate in the global economy. And because they operate on a global scale, cryptocurrencies eliminate the need for currency exchange, making transactions simpler, faster, and often cheaper. Now, let's examine the flip side of the coin, the disadvantages. The most glaring one is the volatility of the market. Cryptocurrency prices can swing wildly within short periods, making them a risky investment. For instance, you might go to bed a millionaire and wake up to find your investment has plummeted. Another downside is the lack of regulations and protections. If you lose access to your digital wallet, your cryptocurrency is gone for good. There's no bank to call, no insurance to fall back on. It's like losing a wallet full of cash in the real world. And let's not forget the potential for misuse. The anonymity that cryptocurrencies offer can be exploited by criminals for illicit activities, including money laundering and financing terrorism. This has led to increased scrutiny from regulatory bodies, which can impact the value and acceptance of cryptocurrencies. The influence of cryptocurrencies on traditional financial systems and communities is also a double-edged sword. While they can drive innovation and competition, they could also destabilize economies if they become a prevalent alternative to national currencies. Having weighed the pros and cons, let's wrap up with a recap and some final thoughts. We've covered a lot of ground today, from decoding the basics of cryptocurrency to diving into the depths of Bitcoin's rise and popularity. We've explored the intricate workings of cryptocurrency, demystifying blockchain technology, and understanding the process of mining. We've shed light on the speculative nature of crypto investments, highlighting the thrilling highs and potentially devastating lows. Through our journey, we've navigated the complex legal and regulatory landscape, revealing the global perspectives on cryptocurrency regulation and acceptance. We've weighed the pros and cons of cryptocurrency, examining its potential to disrupt traditional financial systems. It's been quite a journey, hasn't it? But remember, this is just the tip of the iceberg. The world of cryptocurrency is vast, complex, and constantly evolving. So what's next? Continue learning and exploring. Keep asking questions. Dive deeper into the subjects we've touched upon today. Understand the technology behind your favorite cryptocurrencies. Study the market trends. Learn about the legalities in your region. and most importantly, make informed decisions. As we stand on the precipice of the future, it's clear that cryptocurrencies have the potential to revolutionize the way we handle money, conduct business, and build wealth. Their impact on global finance could be profound, reshaping economies and giving rise to a new era of digital finance. But remember, with great potential comes great responsibility. It's up to us, the users, investors, and enthusiasts, to ensure that this technology is used responsibly and ethically. It's up to us to shape the future of finance in a way that's fair, transparent, and beneficial for all. Thank you for joining us in this exploration of cryptocurrencies. Your curiosity and eagerness to learn are what drive us to create content like this. Don't forget to like, subscribe, and comment. Your feedback helps us improve and deliver the content you want to see. So, until next time, keep learning, keep exploring, and we'll see you in the next video.